Hey everyone, this is Kirk here again at optionalpha.com, showing you guys how to make smarter trades. Tonight we're going to go over all of the trades that we made for Monday, December 15th. Can't believe it's already halfway through the month and I've still got tons of Christmas shopping to do for the holidays, probably like the rest of us. But had a very busy day with the market, kind of continuing the sell-off to kick off the week, and was great because for those of you who are premium members know we talked about a lot of these different trades on the strategy call last night, and we executed them today, which was great to get some good credits. And so we've got a lot to go over, including an FXE adjustment that we made kind of right up until the last week of expiration. But before I kind of do that, I just want to go through a couple little quick housekeeping things. And it's important to watch this because I know that you guys are starting to see inside of the membership area, we're starting to make changes, and you'll see in here that I kind of put this box in here for those of you who are new, but if you've been around for a while, you probably noticed it. But really, it's just a matter of, we're continuing to improve it, and we've had, probably over 30 phone calls with premium members, and it's been really great getting feedback, and obviously feedback from everybody else has been fantastic. So we're continuing to make changes to the website, and we're going to do that live. So some things are not going to work and they're going to look kind of, weird and out of place if you're actually, kind of on the site live today. I know a couple people were actually on some video tutorial pages as I was changing them. So they're kind of being updated right in front of their eyes. But the kind of new layout that we're going with is much more of a training course layout. And it's actually my fault for not doing this a little bit better, to begin with. But that's why it's so great to get feedback from everyone. But I'm going to be doing it very strategically and kind of laying out some different categories and beginner, intermediate, and advanced courses. So more of a course type feel, which is going to obviously add more value. It's going to be a little bit easier to navigate. Things are going to be a lot more clean and simplistic. And obviously we continue to take out a bunch of the junk that's just really not needed, that doesn't help you get anywhere. So this is one of the beginner course training pages, and you'll see on here that it'll start to kind of list all the videos right in alphabetical order here as you kind of go through them. And then as you go to a video like the option strike price video, this is what the actual course video page will look like. And it'll have the lesson description, then you can click on to the next lesson and keep going. So a lot of cool stuff. We're going to be continuing to add downloadable worksheets and cheat sheets as far as entry size, position size, strategy cheat sheets, so that you guys can have those and use those forever, which is going to be really, really awesome. And then obviously we've got a huge announcement about how we're going to restructure, obviously, the membership levels with this new kind of layout. And then obviously pricing is going to be completely different than what it is right now. So obviously anyone who gets in now is going to be grandfathered into current pricing and current structure. All right, so let's get into some of the trades that we made today. Let's actually start with FXE. So FXE, we have kind of a weird iron condor in. We've made adjustments in it before, and we're making one last adjustment right here before expiration because FXE started to go higher early in the morning, and we talked about this adjustment again on the strategy call with premium members last night. But we went ahead, in the logistics of the trade is that we went ahead and sold 4 more of the 122, 121 put spreads for a 30-cent credit. And so really what we're trying to do here is add to the total credit that we've received in the entire trade, and that helps reduce our cost on the trade and reduce our risk. And as long as we kept the number of contracts the same, which is 4, and the width of the strikes the same, which is 1, we didn't actually add any additional risk on this trade kind of right at the money. So this is what the profit loss diagram currently looked like for FXE before we went into this trade today. And you can see it was kind of an unbalanced iron condor. So let me just kind of skew it out here. But unbalanced iron condor, we have, kind of most of the risk to the top side, but we're not even close to getting anywhere. But you can see that FXE was right here on the edge, and it was kind of on the edge of either making money or not. So what we want to do is just, make one last adjustment to reduce the risk in case FXE does move higher, right? In this case, we don't want to be stuck with about a $200 loss. So we wanted to reduce the risk, and we did that by adding a put spread back here behind FXE. So that's exactly what we teach on the adjustments webinar that we just did last week. We add that put spread back here behind it. That now moves the break-even point out further on the top side because of that credit that we took in. So once I actually make this live, here's the actual new position, and you can see what it looks like now. So now by adding that extra 122, 121 put spread, we basically have a butterfly over 122, and you can see that that adjustment now puts the current FXE price right inside of our strategy range. Actually gives us a little bit more room to the top side, so we moved that break-even point out a little bit further. But even more so than that, what we did is ended up reducing our risk on the trade for the last couple days here, barring a huge move in FXE, from about 200 down to about 68. So at this point, it's a really, really good adjustment. That's why I like this adjustment. Continues to reduce risk and gives us an opportunity to make some money in the trade. So I like this adjustment in FXE, and we'll be, pretty aggressive about getting out of it in the next couple of days as well. As far as opening trades, you can see a lot of iron condors, and this is really kind of a tutorial on doing different types of iron condors, because we basically did every type of iron condor that you can think of in today's video. So this is a huge case study in iron condors, and definitely one to watch all the way through. The first one that we did is in SPY, and notice that we kept all of our position sizes small. So in SPY, we did just one of these, but we did something a little bit different, and we actually did an iron butterfly. So this is what looks like a butterfly spread, profit-loss diagram. And again, a butterfly spread looks something like this, right? It's got a tall peak and it's got flat kind of wings. That's a butterfly diagram. But in this case, we didn't use all of the same type of contract or same type of option. So we didn't use all calls or all puts. Instead, we created it by doing two separate credit spreads. So we did the 200-205 call spread above the market, and we did the 200-195 put spread below the market. So we sold the 200, we bought the 205, so it's a 5-point wide on the top. And on the bottom, we sold the 200 again, same price or same strike as the 200 call. And we bought the 195. So again, 5-point wide on that side. So it's an even and balanced iron condor, but it's got our short strikes right at 200. So they're exactly the same. Now by doing this, it basically acts like a strangle. So that's the great part about this strategy. And I wanted to trade a strangle, but considering that we already have a couple strangles in our portfolio, it's just not smart to continue to allocate money towards that. We just don't have enough room in allocation right now to do that. So until we really get through December expiration, start kind of rolling off some other trades, we need to be smart about how we're using our capital, and we just don't have enough room to do another full strangle. So this is the next best thing, because we take in a lot of premium, which is great. We took in almost $400 of credit on this one strangle, or this one iron condor, but it helps reduce the margin that's required to hold the position because we have these long wings on either end. Okay, so let me show you guys exactly what this looks like. We'll first go to the SPY chart here so you guys can take a look at that. And the whole idea here with SPY is that as the market has continued to move lower, then that's obviously given us a great opportunity to see implied volatility jump higher, which allows us to do some of these premium selling strategies. All right, so here's a chart of the S&P, and you can see that obviously the market's had a really huge sell-off, and it's been great for options because implied volatility has kind of rallied. And so it's definitely above that 50th percentile that we're looking for. And so what we're trying to do here is take advantage of the higher implied volatility and doing that, selling as much net options as we possibly can. So when we actually go to the strategy tab or in the risk profile, you can see that this is what our strategy looks like in SPY. And again, it's got that shape of a butterfly, but it's a very low risk, high reward type of a trade. And you can see that obviously the market's trading, I think, let me actually reset these slices here. Yeah, so the market's trading right about 200, right at where our short strikes are. And we just want it to stay between 196 and 204. So that's right where our profit loss break-even points are. And again, you just take that credit and add it and subtract it from the short strikes of 200. But you can see here that we're risking about $102 to possibly make somewhere around $200, $300. I doubt we'll make 400. We got to pin it almost exactly at 200, which is very unlikely. But $200 to $300 for risking about $100 is a very, very good risk reward trade. And again, doesn't tie up a lot of capital. So for us, we're looking at a range of about 194 up to about 204. So a pretty big range given that the market's made a huge move down. So we'd like to see some consolidation. I don't think we're going to hold this all the way till expiration. We just want to see a drop in implied volatility, and then we can obviously exit the position. Now, the trade that we had in DIA is almost exactly the same setup as SPY. It just we're diversifying across a couple different indexes. So we went through DIA and SPY. We did the exact same thing on DIA. we did the 170, 175 call spread, and then we did the 170, 165 put spread below the market. So again, those short strikes are at 170, and then we did 5 points wide on either end. Same look and feel as SPY. So here's DIA. We actually kind of tilted a little bit lower, and DIA rallied a little bit towards the end of the day, but at least we've got a little bit more bearish exposure in the portfolio. But that's what that profit loss diagram looks like. Again, we're risking about $100 to possibly make about $200 to $300 if it stays in this range, and definitely a little bit of a bearish tilt because of the end of the day rally. So, but that's okay. That gives us a little bit more downside exposure and negative delta in our portfolio. So again, really like this trade as far as risk reward. Both of these trades are really great. Moving on to bonds, we figured why not, leave bonds out of the equation. I think bonds have had a really good run up, and I don't, foresee it staying up here too long as we get into January, obviously. So what we did is we did an unbalanced and kind of skewed iron condor here. And so what we did is we did the 130, 132 call spread and the 122, 120 put spread for about 58 cents. Now with TLT, the way that our profit loss diagram looks is definitely a little bit skewed to the downside. So, and it doesn't kind of really reflect here because bonds had just a little bit of a sell-off towards the end of the day. I don't think the charts are going to load here for me, but had a little bit of sell-off towards the end of the day. So that gave us an opportunity to kind of recenter the graph. But again, you can see that we've got ourselves a pretty good distance between ourselves and the market down to the bottom side and to the top side. So we're fairly neutral on bonds, but when we actually entered this trade, we were a little bit bearish and we got some of that move already. We just need to see implied volatility drop in bonds, which I think can happen very quickly. The last trade that we got into today is VXX. So this is one that we talked about on the strategy call last night. I looked at getting into VIX, but I didn't like the premium as well as I liked it in VXX. Now this is a true unbalanced iron condor, and you can see the reason that's unbalanced is because on one side, on the call side, we have a $1 wide spread, so we have the 35.36, and on the put side we have the 25.23, so it's a $2 wide put spread below the market and a $1 wide call spread. Well, that leaves more risk on the put side of the market, so really we're giving ourselves a little bit of edge possibly if VXX goes higher. And we're just kind of protecting ourselves. So saying, if this market continues to be irrational and continues to sell off and implied volatility continues to rise, then we don't want to lose as much if the VIX goes higher and if VXX goes higher. So we gave ourselves a smaller spread on the top side of the market, that $1 wide spread. That gives us a little bit more protection. And in return for that, we had to take on a little bit more risk down below 25. In this case, that's okay because you know what? At this point, if VXX drops, these options are going to drop really, really quickly in value. And again, I don't think the charts are working for me right now because the platform just stinks. But you can see that we already saw a pretty good drop here in VXX today. But this is what the profit loss diagram looks like. I'm just shrinking it down. VXX is currently trading around 32.5, which is right about here. And our profit loss diagram has more of the exposure on the put side of the trade than on the call side. So you can see that kind of graph is much smaller over here, kind of loss-wise, than it is down here. So ideally what we want is we want VXX to trade between about 24 and about 35. But again, if it does continue to move higher, if the market's really irrational, then we're going to save ourselves some money by having a smaller spread up here and only lose about $100 on this trade to make about $100, and then we kind of give up some additional risk down here. But if VXX does go lower, the beauty of this product is that as it goes lower, implied volatility is going to drop. So these options are going to decay in value pretty quickly, and we should have a profit even if it drops and before it drops through our short strike at 25. So again, that's how that unbalanced iron condor is created. I really like it in these types of scenarios where you kind of feel like you have a little bit more potential risk in one direction or another. So it works out really good, and we like that trade. And obviously we can add to it if the market continues to be a little bit irrational. So as always, I hope you guys enjoy these videos. If you have any comments or questions, please add them below right in the comment section. I'll get back to all of those tonight or tomorrow before the open, and happy trading.